Welcome to Taking Stock for the week ending the 13th of May 2022. We're joining me today is our senior equities analyst, Jason Yin, to stream to you all things share market. Welcome, Jason, and thanks for your time again.
It's a pleasure as well, Kien.
But before we get started, just be mindful that the information provided today is of a generic nature and should not be considered personal advice. Shares are volatile, as we've seen over the last week, so make sure you do your research before acting on any information today. And speaking about the market volatility, new data in the US showed that inflation is running hotter than expected at an annualized rate of 8.3%. With fear at the forefront of investors' minds, quality and growth stocks with healthy balance sheets and positive free cash flows are sold down indiscriminately along with speculative investments. Bitcoin, as you know, is down 26% this week and is now trading below 30,000 US per coin for the first time in ages.
Yeah, that's a good point, Ken. I mean, locally in Australia, the volatility may have actually opened a window of opportunity for some investors. And what better way to find these opportunities than with Stock Doctor's filter tool? So for example, let's create a new filter and call it opportunities. We then added the following criteria: star stock status, price change 6 months, and 12-month EPS forecast revision over the past 3 months. We then sorted the results by change in share price over the last 6 months and looked for companies that have been sold down aggressively, but continue to exhibit positive earnings revisions over the last 3 months. The important thing to remember, though, is once you have these results, run these companies through the 9 golden rules process to determine if the investment is actually suitable for your risk profile.
Yeah, so let's have a look at that list and use IDP Education as an example. The stock has declined by about 40% over the last 6 months, but earnings have been revised higher by around 12%. If you look at IDP, it is a borderline star growth stock that offers investors exposure to the growing migration of students to English-speaking countries via its operations in English language testing. Earnings growth remains strong under Golden Rule 3 outlook and active risks as the company recovers from travel lockdowns.
Also in the strategic comment, be mindful that we did flag that the company CEO, Andrew Barklow, is expected to step down in September 2020, and he has sold down over 62% of his holdings in the last 12 months. Short interest in the stock is also slightly elevated at 6%. So these are the risks investors really need to be comfortable with before considering an exposure.
Yeah, and there are plenty of other ideas on the list as well. So go through them and, of course, conduct your own due diligence by referring to our 9 golden rules framework. Let's now turn our attention to some potential opportunities over the week. We had Building Products Group and borderline star growth stock, CSR. They reported a 24% increase in earnings growth in its 2022 result. But what stood out was that the company was still able to maintain its profit margins in the face of higher raw materials, energy, and also freight costs as well.
Yeah, that's right, Ken. The company was able to do this by taking advantage of higher aluminium prices and putting through a price increase in late 2021. The company has also a 25% stake in the Tomago aluminium smelter in New South Wales and has significant hedge positions out to 2026. Despite the higher earnings, though, the stock was sold down on broker target downgrades and perhaps on concerns that higher interest rates could dampen building construction demand.
And from an outlook perspective, management remains quite upbeat. Remember, consensus is forecasting growth to be driven by supply constraints, which have led to housing construction timelines extending beyond the 12 months. And the federal government's home builder program should continue to support demand as well. Meanwhile, CSR, remember, they can still increase the prices of their products to offset rising input costs because of their strong market position.
Another borderline star stock that operates within the housing market is also REA Group. Unfortunately, the stock was sold down following its third quarter update. Management pointed to an 8% slowdown in national listings during April, but the upcoming election could also act as a headwind for listings as well. Furthermore, the company also noted that high operating costs and marketing expenses could also be a bit of a headwind on earnings.
Yeah, but looking at Stock Doctor, the growth numbers under Golden Rule 3 remain positive. Even though interest rates have begun to rise, they remain low by historical levels, and the group remains confident that they will report a strong set of full-year numbers and stated that any immediate headwinds from the election should be offset by growth in its data and financial services business, which is a growing segment of theirs, representing about 3% of their total revenue in the last financial year.
Interestingly, the share price weakness in the stock may present an opportunity for some investors who believe in the strong fundamentals of the business. But those that are trend sensitive should also be mindful that the stock has signaled both an exit on the SD Max and the SD30 TSR. So members may have also noticed that we removed Janus Henderson Group from our star stock universe over the week due to active risks. And that came from its fund outflows and poor market performance. So please refer to our strategic comments for all the details.
And Jace, looking at our corporate calendar for the week ahead, we have building materials manufacturer James Hardie reporting their annuals on the 18th of May. We also have Woodside Petroleum's AGM next week, while Macquarie and Westpac, they are due to go ex-dividend on the 16th and 19th of May, respectively.
All right, so given the recent volatility in equity markets, it's not surprising to see a higher than average number of bearish trend changes on Lincoln's technical indicators. So for the highly sensitive investors, utilizing the SD Max, which stands for the Stock Doctor Moving Average Crossover, Arena REIT, Bank of Queensland, Jumbo Interactive, Lioness Rare Earths, Nine Entertainment, Rio Tinto, and WiseTech all turned bearish. However, ResMed and DDH1 Limited also signaled an exit on the SD30 TSR, which is the Stock Doctor 30% stop loss from its highs and gains from its lows. There were no bullish changes observed in both the SD Max and the SD30 TSR this week.
In Under the Microscope this week, we take a look at borderline star growth stock and star income stock, AUB Group. The company is the largest insurance broker network in Australia and New Zealand. So given its large presence locally, what prompted the company to make a bid for Tysers, which is the 6th largest wholesale broker based out of the UK?
That's a really good question, Kien. The reason outlined by management is so that it can provide synergies and scale within its insurance business value chain. The company flagged operational synergies of around $25 million Australian dollars, and that represents around 20% of its forecast pre-tax earnings in FY23. From a strategic perspective, the deal will almost double AUB's gross written premiums, which is a proxy for revenue, from around $4 billion to $8 billion.
Well, that is quite large. Remember, Tysers is to be acquired for $880 million, and this will be funded by a $350 million equity raise and debt as well. Now, the total deal is significant. It's at 60% of AUB's market capitalization. So the question is, are you able to help members understand the company's rationale for raising debt despite them reporting $272 million of cash on the balance sheet?
Well, you have to remember that a majority of that cash, or around 196 million, relates to client funds, which is held in a trust. So this only leaves around $75 million in cash that can actually be deployed. Hence, this amount is insignificant, or insufficient, I should say, and AUB needs to tap debt markets for more capital.
Yeah, and with such a large acquisition as this, we are quite skeptical about the acquisition, especially due to the heightened operational risk that can emerge. So with the share price falling to the offer price of around $19.50, should investors really participate in the offer?
That's definitely an interesting question. I think from the perspective of growth investors, they should be mindful that this will likely create a dilutionary impact on earnings metrics such as return on equity and also earnings per share in its FY22 result, since the transaction is not forecast to complete until the first half of 23. The forecast return on equity is also expected to be weaker at 9.3%. So this looks like AUB will not be able to meet Lincoln's growth metrics in the coming period.
And although the price paid for Tyser does not appear expensive, we are mindful of the emerging risks to the overall business, including the increased debt, which could impair the business's financial health, especially when cash flows are delayed, as you mentioned before, Jace.
Yeah, there's also risks associated with operating in a new geography and management cohesion within the two merged entities. For income investors, a gross dividend yield of around 4% is a little bit low to compensate them for some of these risks. But if you are still comfortable with these risks, please note that the offer price of $19.50 is pretty close to the current market price. Hence, it may be prudent to wait until the end of the month, which is when the offer will close, to determine if there is value in participating. Now, if you're a highly trend-sensitive investor, the SD Max is in bearish trend, so you should remain on the sidelines until a more positive price trend emerges.
Following on from the bank reporting season, a pertinent question for investors this week is, what are our thoughts on the bank results, and are dividends still sustainable?
The key thematic from the bank reporting season is that the banks experience net interest margin compression. Now, this is the notional difference between the rates that they charge on their loans and the deposit rates that they pay out. The pressure was due to heightened pricing competition amongst the other banks and in an effort to gain market share. Another reason for the decline in net interest margin is due to the large percentage of fixed rate mortgages, and this could not offset the higher funding costs over the period.
Yes, Jason, and from a financial health perspective, the banks are well capitalized and credit quality remains quite strong. The number of home loans more than 90 days overdue continues to fall, and impaired assets represent only around 0.5 to 0.9% of all loans. So, Jace, which results really stood out?
Well, Star Income Stock Westpac exceeded market expectations due to lower bad debts and significant cost reductions, which fell by around 10%. Now, unlike ANZ and NAB, the bank was able to retain their cost guidance in the face of inflationary pressures like rising wages. Amongst the other majors, Westpac currently has a gross dividend yield of around 7%, and this is expected to go ex-dividend on the 19th of May.
Yeah, outside of the traditional banks, Jace, the result from Star Growth Stock and Star Income Stock Macquarie Group was also a standout, with the return on equity at 18% and net profit margins improving to 36% on the back of elevated commodity markets and deal volumes as well. Unfortunately, though, the stock was sold down on expectations that deal volumes and commodity price volatility, that's going to normalize over time. But the dividend yield was also below expectations, with the stock on a gross dividend yield of around 4%.
The market is anticipating earnings growth for Macquarie to slow to double digits in FY23, and the group has warned that the huge profits are unlikely to be repeated in the next financial year. But given that the company has historically been conservative in its outlook, the share price weakness may represent an opportunity.
Yeah, and once again, Stock Doctor can help you compare the banks to help you decide which is best for you. And you can use the peer comparison table at the bottom of the 9 golden rules screen, or refer to the Stock Doctor filter tool or watch list by selecting Star Income Stock portfolios or creating your own. For example, you can create a new filter, then select banks and capital markets under the GICS classification. Now select the relevant fields you are interested in, such as franking, gross dividend yield, the dividend payout ratio, ex-dividend dates, and the forecast EPS revisions.
And then sort the field that you're interested in. So for example, you can sort by forecast gross dividend yield or the ex-dividend date. Then you can compare the banks by looking for those with the highest dividend yield or positive earnings revisions. Note that both Westpac and Macquarie are expected to go ex-dividend very soon.
And from this list, you can see that all the banks have experienced stable or positive earnings revisions. And this should help sustain their attractive gross dividend yields of 7% on average. The payout ratios appears unstretched, and higher interest rates in the coming year should put less pressure on their net interest margins, although we will continue to monitor the bad debts and the delay in loan repayments. And please refer to our Taking Stock video last week to understand how rising interest rates can benefit the banks. For now, though, that's all we have time for. Thanks, Jace, again for your contributions.
Always a pleasure, Kien.
And just a reminder to tune into our Lincoln Live webinar this Monday. Unfortunately, Tim won't be able to attend this week, but I'll be there with Matt Swartz and Robert Manfrey to help answer your questions on stocks, the market strategy, and the Stock Doctor platform. So the key messages for today is, once again, volatility creates opportunity, and Stock Doctor provides the platform to look for those opportunities. For now, take care and have a happy, healthy, and prosperous week, everyone.